Good morning and thanks so much for tuning in. You're watching Trade Talk on BQ Prime. My name is Mathew and with me is Hiral Dadia. Morning, Hiral.
Good morning, Alex.
Well, it was a bit of a listless start to the trading week for the Indian equity markets, but things are looking up. Today, across the board, risk assets are up, and that's probably, ostensibly, because the US president is going to Israel with the intention of trying to ensure that geopolitical tension does not spread to other regions. At least that's the reason we're looking at this morning. But here in India, the focus, I think, is going to be on the financial space very clearly. The Nifty Bank didn't do too much yesterday, but it could be very active today.
Absolutely. With the reaction that would come in with regards to HDFC Bank as well as Geo Financial Services, two from the BFSI space, that will see some bit of an action in trade today. But clearly, if you see in terms of markets as well, a close above those 19,700 levels is what we saw in terms of Nifty 50 yesterday. So again, that 19,800 is becoming that crucial level which Nifty is really not able to surpass as well. So that's an interesting aspect to watch out for. You have the PSU Bank as well as the metal stocks, which outperformed in trade yesterday. So yes, the private banking space was weak, but there was some bit of positivity coming in there. And apart from that, there is that positive trend which continues with regards to where real estate companies are concerned. Apart from PSU banks, you had a lot of other PSUs which were non-banking PSUs which were up in trade. You had the likes of ITDC or MMTC. All of these counters which were seeing a run-up to the tune of almost 10 to 15%. So clearly we are seeing that stock-specific action, Alex, but the focus will continue to remain in terms of financials because you do have a Bajaj Finance that will be reporting numbers as well today.
And we have some sense of what the quarterly performance was, and it's widely expected to be a good set of numbers based on what we've seen. But let's focus in on HDFC Bank, and in fact, we've got Bunty Chawla joining in to give us some perspective on the results. Bunty, thanks so much for taking the time and for speaking to us about HDFC Bank this morning, because I think there are a lot of social media posts, there's a lot of discussion as to how to read these numbers. At least optically, even though they have stated very clearly that the year-on-year numbers are not comparable at all, they haven't restated it, HDFC Bank, so that number is 50% higher, but it doesn't take into account the impact of the merger. And so there are certain calculations that are pointing to the fact that impact, if you take that into account, the increase in PAT number is only about 10%, and that is reflective in the EPS growth, which is about 11%. So how are you looking at the numbers this morning?
So as you rightly said, they have on a YOY basis, it is difficult to compare, but it's good. They have given on a July pro forma numbers on a merged basis. So if you see advances or the balance sheet side, if you see, so advances has grown by 4.9% on a Q1Q basis. So if you annualize it, because it's a quarterly growth, so if you annualize it, it comes to around 19%. So that gives us a confidence that it's on a credit growth, they are on a steady path, which they have said that they will be able to grow after the merger as well. Secondly, on the deposit front, as we know, after the merger, they require too much of strong liability to continue the growth path because large amount of borrowings from the HDFC Limited has been shifted to the merger path. So now if you see the deposit growth also on a merged basis, they have given that has grew by 5.3% on a Q1Q basis. That if you annualize it, comes to around 21%. So on a balance sheet side, if I see the numbers, annualized numbers, if I annualize it, so 19 to 21% growth seems to be very optically strong number after the merger numbers as such. So we believe this is a strong set of numbers with respect to balance sheet. Secondly, major focus for the banking or for the HDFC Bank merge was the margins. As they have previously highlighted, because of the high liquidity on the balance sheet, there will be an impact on the margins, which is visible, though it was slightly higher as per estimates or as per previously expected. They have reported 3.4% net interest margin in Q2, which was down 70 bips after the merger. And that is purely, they have said that higher liquidity which they carried on the balance sheet was approximately 25 bips. If I adjust with that, it comes to around 3.65%. So roughly, they have previously guided they will be having a margin after the merger of 3.8 to 3.9%. So still lower than their earlier margin of the run rate. So it seems to be this is the part which needs to be focused now, how the margins will improve from here on or from Q3 onward. Though in the con call they have highlighted there are few levers for them in terms of margin improvement. First is higher liquidity, which they already carry, will be utilized in the credit growth going forward, and they have non-individual portfolio which in terms of construction finance will also grow, and there are few high yielding assets which will they will try to grow, so that will be having a positive impact on the margin front as such. So overall I will say balance sheet side strong numbers, margin slightly lower than estimates, overall stable set of numbers we can say.
Right. So overall, it seems, I mean, yes, optically as well, the numbers have been above what the street was estimating, but clearly the net interest margins from here on is going to be a focus, and there's no worry coming in on the growth perspective. Bunty, how are you looking at the asset quality front? Because, and this is specifically taking into account the non-retail book after comments from the HDFC Bank CEO as well, that there could be some tail remaining from this book, which could actually slip into substandard in the future. What does this actually mean according to you, and how do you think it will impact the overall asset quality from here on?
So as you rightly said, on the merged basis, asset quality, if you see on a, they have shared on the July number itself, it was 1.4%, and it has improved slightly to 1.3% Q on Q. But if I try to compare with the standalone HDFC Bank, it was slightly higher, because you rightly said non-individual accounts of HDFC Limited has been shifted to NPA. They say that is the RBI classification which we need to follow, because that was restructured assets for HDFC Limited. So that has been shifted to HDFC Bank. Now coming to the impact, the good part they have said is that though that has been shifted to a gross NPA, but we have already maintained the PCR at 74% versus PCR which was followed by HDFC Limited around 35, 40, 42% kind of a thing. So if there are some hiccups or some tailwinds coming from this non-individual accounts of HDFC Limited, there will be no impact on the PNL part, or ultimately the return ratios which they are guiding around 1.9 to 2% on a sustainable basis, which they have done historically, and going forward they will be able to do. So I on the PNL part, I don't think so there will be an impact, but few bips here or there on the gross NPA percentage will not have a much of a deterrent on the asset quality front.
Okay, so we've discussed loan growth, we've discussed deposits, we've discussed the NIM, and we've also discussed asset quality. But Bunty, the bottom line is on the earnings and the trajectory of earnings. And everybody will understand if one particular quarter goes by with teething issues. The stock has underperformed since the merger, very clearly, down over 10% so far. The question that I think a lot of investors will want to know is, should they hold on? Should they buy on dips? What is the outlook 1 year down the line?
So as you rightly said, previously before the numbers have come, there were few question marks on the performance basis. That is the reason the stock was quietly underperforming. Now the numbers are purely visible after the merger, how the growth is panning out, how the margins could have been impacted, which is visible in Q2, and there are chances there will be improvement in the margins. And ultimately, the from the investor point of view, generally focus on ROA and ROE, as they have already reported ROA of 2% in Q2 and sustainability of ROA of 1.9 to 2% for next few years or on a sustainable basis, along with the impact of new equity on the ROE, which has dipped from 17 to 16%, that is also manageable. So if I see after the numbers, it is clear the merger impact is almost visible in the numbers. Now there are chances there will be an improvement from here on in terms of performance, in terms of margin impact, or in terms of return ratios. So we believe this is the time to accumulate the stock, because if I see the historical valuation we have seen from FY14 to FY24, in fact last 10 years, if you see the 1 year forward price to book valuation, their average is around 3.1x price to book, and their standard lower division is around 2.4x. So currently on a 1 year forward, it is trading at 2.4x, which is lowest in last 10 years, and this valuation has touched this valuation at the time of COVID, if I remember, in June 2020, kind of a thing. So I believe valuation is quite comfortable. Clarity about the numbers after the merger is visible for the investors, so they can take a call at this time. Our view is we are very much positive on this with the target price of 1970.
Right, that's an interesting point that you've made as well, Bunty. And I think, as you said, a good time to accumulate a HDFC Bank. Thank you so much for joining us on the show and sharing your views, because that has been a crucial question since the merger as to whether one should hold book profits and re-enter at a later stage or not, and this gives you some bit of clarity that does come in as well with regards to HDFC Bank. But moving on, another BFSI company that has reported numbers for the first time is a Geo Financial Services. Again, there was a lot of ambiguity here as well as to what are the kind of numbers, what is to be considered. Let's understand from Varsha as to what the numbers look like. And apart from a JFS, which are the other companies that you're tracking? Good morning, Varsha.
Good morning, guys. So on the face, it looks like Geo Financial has doubled its net profit, but let's deep dive and see what the numbers are. So the total income rose by 46% at rupees 608 crore from 404 crore in Q1 FY24. Now the lender's interest income was at 186 crore, dropping from 202 crore in April-June FY24 quarter. The consolidated net profit of the company for the second quarter doubled to 668 crore from 331 crore last quarter, which was led by dividend income of rupees 371 crore. Now, if you see the standalone profit after tax was at rupees 89 crore in Q2 FY24 from rupees 145 crore in Q1. Now, following the release of the second quarter results, the firm also announced the appointment of A.R. Ganesh as Group Chief Technological Officer, forming part of senior management personnel. Then next we have ICICI Securities, where the total income came in almost 1,249 crore, which is 44% higher than September 22 quarter. The surge in income was driven by cash and derivatives segment, marking a growth apart from momentum seen in investment banking segment. Also, company posted a net profit of 424 crore, marking a surge of 41% as compared to year ago period. Its client base reached 95 lakh mark during the quarter under review, as it added around 2.24 lakh clients during the 3-month period. Also, company has approved the payment of interim dividend of rupees 12 per share, and the record date for the dividend payout has been fixed on October 27th. Then we have CNDLM, where the revenues were up 71%. The strong year-on-year growth in revenues was driven by aerospace and defense segment. The EBITDA was down, but if you see the margins, there was a drop due to one-off gains in FY23 and adverse revenue mix in Q2. Also, the PAT for the company doubled, which was aided by other income. Lastly, we have CEAT, where company's revenue was up 5.5%, but the margins was registered at 14.9% compared to 7% a year ago. The product mix and judicious pricing helped improve margins during the quarter. Also, there was steep rise in net profit of rupees 207 crore versus 6 crore last year due to decrease in material cost by 14%, and company has also worked on cost efficiencies in past few years, and there was tax impact also, due to which we saw the huge rise. Now, company is witnessing mid-single digit growth in top line across all 3 segments, that is replacement, OEMs and international business. Also, company has managed to bring standalone debt down by 103 crore.
Oh, absolutely. Interesting. Very interesting. Varsha, thanks so much for joining in. JFS, because a large part of that income coming in from dividend income. And so it kind of skews the picture a little bit. And also CEAT, 32x jump in net profit with a huge spike in margins. That stock is going to be active for sure in trade today.
And there is an exceptional in terms of CEAT as well. In fact, we will be speaking to the management in stocks to watch at 11 o'clock. So a good time for you to come in and watch and understand as to what's brewing there.
And the other aspect, of course, is HDFC Bank. If you've got any questions, do tune in at 11:30, because that's when we have Ask BQ, and that's a show that is designed specifically to get all of your stock-specific questions answered. We have a few more updates in terms of notifications that have been sent to the stock exchanges, and Rishi is joining in to give you some perspective on that. Rishi, what's on your list today? Good morning.
So, of course, the top of the list is Grasim, where it has announced a fund a rights issue fundraise of about 4,000 crores. And this is, of course, to further its paints business capex and also to repay any of the loans that will be there. Now, the market launch of its paint business that is named as Birla Opus is expected in the fourth quarter of the current financial year. And it has already committed an investment for this paint business of about 10,000 crores. Now, the promoters have said that they'll subscribe to their own issue entirely, and also if there is any unsubscribed portion, that's also something that they'll subscribe to. That shows how much confidence that they have is what the company is showcasing it to be. Then Grasim again aims to be the second largest decorative paints player after Asian Paints with a total capacity of 1,332 million liters per year. And do note that Grasim's shares hit a record high when the board was mulling this fundraise. Now that the fundraise is in, it could quite well breach the highs, and it's just 2.5% away. So that's quite a possibility. So do look out for the stock. Apart from this, there's KC International, which has bagged multiple orders worth 1,315 crores. And these orders in the transmission line, it is for a 765 kilowatt transmission line and an AI substation. And this order is from the Power Grid Corporation. Apart from this, it has also received orders from international clients. And this is for the order of supply of towers in the Middle East, Australia and Americas, as well as the supply of hardware and poles in the Americas. For its cable business, which the orders are to supply different types of cables, and this is again in India as well as overseas. Now, there's also Tata Power, which has signed a power delivery agreement with Endurance Technologies. Now, this power delivery agreement is to set up a 12.5 megawatt captive solar power plant for Endurance Technology in Maharashtra. Now, this plant will generate about 27.5 million units of electricity, and it will, again, because it's a renewable energy, it will help in reducing the carbon footprint of Endurance. Then there's Coal India, which is announced, which has given an update with regards to a half-monthly update, if I can say. So the total supplies have been up by 16% year-on-year for the first half of October to 28.6 million tons, and also the FY24 supplies to power plants till October 15 stand at 390 million tons. So this, which seems to be in line with its overall FY24 target of 610 million tons of offtake to the power sector specifically. Now, then there's GMDC, which said that the company had raised its dividend to 11.45 from 9.1 for FY23, and it has now presented about 270 crore worth of dividend check to the Gujarat government, which owns a 74% stake in the mining company. And the total dividend payout therefore comes out to be 364 crores, which is quite an uptick from what it paid in the last year. Then there's Bombay Dyeing, which has transferred land, its Worli land, along with its FSI facility to a Sumitomo Realty subsidiary. Now, it has received about 4,675 crores worth of payment for this land parcel, and apart from this, it has said that it will use these funds to repay loans, as well as it will use the remaining funds to undertake any investments in marketable securities.
So that's going to be an interesting list to watch out for. GMDC was absolutely active in trade yesterday as well. So let's see how this entire set of Gujarat-based PSUs pans out on the back of the dividend income that could be announced. But very quickly, let's just run through the list of earnings that will come out today. We've already spoken about Bajaj Finance, but apart from that, ICICI Prudential, L&T Technology Services, Syngene, Happiest Mind Technologies, Canfin Homes, Zenzar, as well as IFL Securities. These are a few of the names that you can see on your screens that will be reporting numbers in today's session. So yes, a lot of stock-specific action, Alex, that could be expected in today's day of trade. A lot of managements that we will be speaking to at BQ Prime as well, and a lot of your queries that could be answered on an HDFC Bank as well, as Alex mentioned. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BQ Prime.